Hey, welcome back, Business 163, Personal Finance. And in this module, we are looking at the whole topic of insurance. And this module is going to be packed because there's a bunch of different types of insurances out there that we need to know if we're going to be financially literate, if we're really going to understand how to best protect or at least reduce the risk of exposure and risk to the things that we own, the things that we love, the things that we want to take care of. That's really the spirit of this module on insurance. So let's get started right away. You can see here from the title slide, this very first video looks at insurance fundamentals. We're going to be talking about several different types of insurance in this module, from renters and homeowners insurance to auto and health insurance, but all of these types of insurance have some similar fundamentals, how they work, why insurance companies can't offer insurance to us as individual consumers. The basic principles are sort of the same. So let's get into this by first considering something that I think most of us are familiar with, or at least the risk of, and that is, what does it cost to insure your iPhone screen? Here, of course, you have a picture of maybe an image that many of us are familiar with. If you've ever had the misfortune, perhaps, of dropping your iPhone, maybe you've dropped it before you had a chance to put on a screen protector, or maybe the case that you bought for your iPhone, well, didn't really protect it the way you wanted it to, or, well, all sorts of things happen in today's world, right? We've all got these thin little phones with glass screens, and so this is something that can happen a lot, right? So how much does it cost to insure your iPhone screen? Well, let me see if I can give you some numbers. As of the most recent numbers I've seen, what does it cost to insure your iPhone screen? Well, how much does it cost to fix it? Well, you can see here in this table, the column on the left-hand side, if you don't have any insurance and you crack your screen, on average, it's probably going to cost about $280 to get that screen replaced. And of course, that varies depending on the model of phone you have and, of course, where you take it to get fixed. But that's a good price, okay? It's a good average price. And then if it's something else besides a cracked screen, you can see there, well, holy smokes, it may be anywhere upwards of $450 to $550 if it's something else that needs to be fixed, if something else breaks. And then, of course, if you the phone is just lost or it's stolen from you, well, if you don't have insurance, you're going to have to pay full boat to get another phone, right? However, with Apple's own insurance, which is sometimes known as Apple Care Plus, a cracked screen will cost you all of $30 out of pocket for you to get that thing fixed. And another type of a problem, any other kind of break, is going to cost you about $100 out of pocket to fix. And if it's lost or stolen, it'll cost you a total of $150 to replace that phone. That's a much better deal than the column on the left. Wouldn't you agree? Well, here's the deal. Look at the prices at the bottom. The cost of Apple Care Plus, you can see there, if you just want to get coverage for repairs, when you purchase the phone, it can be a one-time cost of $150 to $200, depending on the model phone. Or if you choose, and Apple Care has just introduced recently a monthly plan, you can pay $8 or $10 a month every month to secure that coverage. Now, if you want to include coverage for loss or theft, you can see the numbers there on the bottom. But of course, here's the deal. If you look at those costs, those premiums to purchase Apple Care Plus, compared to what it's going to cost you if you drop your phone and crack the screen, well, you can see here, there's a strong argument that maybe buying the insurance is, quite frankly, a good deal. Now, I don't work for Apple, as you know, and I'm not selling Apple Care Plus insurance. And quite frankly, I'll be honest with you, on my own personal phone, I don't have Apple Care insurance if I crack the screen. It's an older phone. It's an iPhone 8. And so, if something happens to it, yeah, I'll probably just get another one. But I don't have Apple Care Plus insurance. I have no, skin in the game on this. But I'm just telling you from a financial perspective, right? If we turn to the slide, you can see there's a pretty persuasive cost that if you can afford to purchase the Apple Care Plus right up front when you get the phone, it could really save you a pretty significant chunk of money if you are prone to dropping or cracking your phone. Now, that's just an example. It's an example of a type of insurance that all of us can relate to. And what I'm going to say now, that this concept we're going to introduce in the next slide, really doesn't have to do anything with AppleCare. AppleCare charges the same no matter if you have a history of slippery fingers or whether you're the type of person where everything is always very carefully placed and protected. It doesn't matter, right? If you're an Apple customer, you pay the same as everyone else. But that's not quite how most large insurance works. And for that, we go to the next slide and consider the concept of risk pooling. What is risk pooling? In insurance, risk pooling is the concept of grouping large numbers of people together to minimize the overall cost impact of the highest risk individuals. So if you look at the little diagram here on the right that I've given you, you can sort of see here that what we're trying to illustrate is folks that are color-coded, from green being, well, not very risky people, to the getting a little more yellow, that's more the medium risk people, and then the red is the highest risk people. And so what you're doing here is you're trying to group together people of varying different types of risk into larger pools and charging them a premium based upon their risk categories. And so you can see here in the bullet points here that to try to minimize the overall cost impact of the highest risk individuals in the group, health insurance, auto insurance, home insurance, life insurance, they all practice some form of risk pooling by insuring people who are unlikely to need insurance to cover the costs of people who are more likely to eventually need to use the insurance. And so it groups high risk and low risk people together in the same group, high risk people generally paying more. And the whole idea here is that risk pooling transfers some risk exposure from high risk customers across the large group of low risk customers for a lower overall risk. All righty. So the whole idea here of risk pooling is to accomplish risk transfer. This is the key principle that makes insurance risk. The premiums of many pay for the few who need it. Again, the risks of the many, the premiums of the many pay for the few who eventually need it. And therefore, as you might guess, the larger the pool of individuals, the larger the insurance pool, the lower the overall costs. I can give you some obvious examples here. That's why employer-funded health insurance with large companies costs less, and also why larger automobile insurance companies, nationwide automobile insurance companies, can offer you a lower premium than smaller insurance companies with a smaller risk pool. All right? So that's sort of the idea, the general idea that makes all of this insurance that we're going to talk about in this module, in Module 12, really work. The reason why premiums are, well, somewhat affordable, if not very affordable, depending on the type of insurance, is because of the idea of risk pooling. Now, here is briefly some insurance vocabulary that you will really would do well to study and learn, not only for this class, but for your own financial well-being, so that as you talk about different types of insurance, they all have similar vocabulary terms, this lexicon. So no matter the type of insurance, when we talk about the deductible, what we're talking about is, well, if you make a claim, if you have a deductible and the deductible applies, that's the amount you have to pay for out of your own pocket for a loss before the insurance starts to kick in. Whereas the limit of the insurance is the maximum amount the insurance company will pay for a covered claim. What's a claim? A claim is a formal request to your insurance company for it to provide money after you suffer a loss which is covered by your policy. Coverage is exactly what you're buying and how much of it, specified in the policy, when you purchase that insurance policy. Lots of details there about what's covered, what might not be covered, how much the maximum they'll cover for any particular type or category of loss, etc. What is the premium? The premium is the amount of money you pay on a regular basis to keep your insurance policy active. All right? And then finally, the term is the time period between when your coverage begins and when it ends. And so that's a basic lexicon of standard vocabulary for you to be able to understand and really get a handle on the videos we'll have in the rest of this module as we begin to look at specific types of insurance that perhaps we all should consider. Alrighty, hope that's helpful as we just get started with Module 12 on insurance. We'll see you in the next video.